Have you ever watched a company officially announce a massive, record-breaking earnings beat, only to see its stock completely plummet by the next morning? It's supposed to be a champagne moment, but it suddenly turns into an absolute disaster. You're just left scratching your head, wondering how the market could possibly react so negatively to undeniably good news. Look, it is one of the core frustrations of trading, but today we're going to unpack exactly why this happens, and way more importantly, how you can avoid getting caught in the crossfire.
Welcome back to The Explainer. Today, we are conquering two distinct traps that routinely destroy amateur portfolios. The first is the highly predictable, scheduled danger of earnings announcements. The second is the chaotic, entirely unpredictable reality of sudden news shocks. We're going to arm you with the exact protocols and mental frameworks you need to navigate both of these extremes like a pro. Okay, let's dive into this. Here is our roadmap for today. First up, the announcement trap. Then we'll hit the earnings protocol, move on to exogenous shocks, and finally, checkers versus chess thinking. All right, part one, the announcement trap. Buy on the rumor, sell on the news. This is where that classic Wall Street adage actually comes to life. To really get this trap, we need a super quick recap from our previous explainer. Remember, beating the official Wall Street consensus estimate? It means absolutely nothing if that good news is already priced into the stock. Stock prices are just the present value of future expectations, right? So if a stock has already run up on anticipation ahead of earnings, well, the good news was priced in before the report even hit the wire. So when the numbers actually drop, the early buyers sell to take their profits, and boom, the stock tanks.
And here is the actual physical danger of being caught in that trap: the gap opening. If you're holding a brand new position right before an earnings announcement, you are completely exposed. A gap down at the market open literally means the price leaps straight past your stop loss. There is zero price fill in between yesterday's close and today's open. So you have absolutely no chance of getting out with a small, manageable loss. You are just completely trapped. It's brutal.
So the crucial point is how we fix this. Let's move to part two, the earnings protocol, before, during, and after.
To survive that gap trap, you need a highly systematic approach. Here is your exact, executable three-step playbook. Step 1. Before. Always check the earnings calendar for your specific stock, but also look for the sector's bellwethers. A massive bellwether company, think like Intel or General Electric, often previews exactly how the entire sector is going to trade that week. Step 2. During. Basically never open a new position right before an announcement. As we just learned, a gap makes your stop loss completely useless because the price just jumps right over it. Step 3. After. Just wait. Let the market digest the news over a session or two. Honestly, a gap down usually means the trap has already sprung on the bulls, and chasing it late? That's exactly how latecomers get crushed. Just wait and confirm the trend before you act.
All right, shifting gears a bit. Part 3, exogenous shocks, trading the unpredictable.
And that brings us right into part 4, checkers versus chess, tracing those second and third order impacts. Okay, so we are now leaving the highly scheduled, super predictable world of the earnings calendar and diving headfirst into the chaotic reality of sudden breaking news. When these crazy, unpredictable shocks hit, we're talking natural disasters, massive strikes, things like that. There are basically two distinct playbooks for handling them. Checkers thinking just reacts to the news itself, the obvious first order impact. But here's the thing, by the time you trade that, it's public and it's already priced in. Chess thinking, on the other hand, reacts to these second and third order implications. The chess player thinks 3 moves ahead, looking downstream for connections that almost nobody else is trading yet. Let's look at a really vivid historical example, the 1986 Chernobyl nuclear disaster. When that reactor caught fire, the checkers player immediately shorted the utility companies that owned nuclear reactors. But, that was public knowledge within hours, right? The edge was instantly gone. Now, what did the chess player do? Well, they realized the radiation contaminated Ukraine's wheat belt, which is one of the world's absolute largest grain-growing regions. That meant global grain supplies were going to tighten up, driving input costs way higher. So the chess players shorted grain-dependent food processors like General Mills or Quaker Oats. They traced the shock downstream to where margins were going to get completely crushed months later, acting on a connection nobody else was even looking at yet. So let's see how you can apply this today. Imagine you get a breaking news alert right now. A major port strike just shut down West Coast shipping for 2 straight weeks. Checkers thinking immediately says, oh, short the shipping companies. But we know better than that now. What is the actual chess move here?
Here is the reveal. You actually avoid the shippers entirely because that bad news, it's already priced into their stock the literal second the strike is announced. Instead, you trace the shock downstream. You short the import-dependent retailers who rely on just-in-time inventory because guess what? They are about to face empty shelves and massive lost sales during that strike. Conversely, you look at domestic manufacturers who are completely unaffected by that specific port. Suddenly, they're showing major relative strength. And that is where the real edge lives. So remember this as an absolute rule. The real trade is downstream, not the initial point of impact. A shock's real financial impact is rarely the first company it touches. Seriously, a word of warning. By the time a shock's obvious first-order target is trending on financial news television, that trade is long gone. The profit is always, always one step further downstream. All right, you now have the exact before, during, and after protocol for earnings dates, plus the mental model to turn sudden chaos into a totally calculated chess move. So here's my challenge to you. The next time a major shock hits the news, force yourself to name the second-order effect before you even let yourself acknowledge the first. Give it a try. Next time on The Explainer, we're going to cover the most systematic market mover of them all, government, fiscal, and monetary policy. Until then, stay focused and keep thinking 3 moves ahead.